Lesson number 8, I want to focus strictly on entries and exits. I will be looking at candlestick patterns, multiple wick formations. I will be looking at inside bar formations. I will be looking at counter trend lines. And I think I've touched a bit on that on the previous video, but I will be going a bit in depth on that and knowing the difference between a breakout and a fake out, and knowing the difference between and knowing and actually being able to identify rejection. Sorry. So I will be selecting a clean chart for this lesson. So I don't want to actually work on a chart that has been worked on before. I will be using a chart that only has these monthly zones, and I'm going to try and at least try and cover an analysis. I'm going to do an analysis, and then actually before I do that, let me cover let me actually do an analysis. It's fine. Let me go to a chart. Let me go to a chart. USD pairs. Let me go to Euro USD for the sake of this lesson. So obviously you will draw all the lines on your charts. Draw the daily lines. Actually, I think I need to do an empty chart. I need to do an empty chart. Let me go to UJ. Yes. So on UJ, guys, I have these zones marked out. Let me just delete the irrelevant ones on the charts, and then have all the relevant lines ready. So you would have had your monthly levels on the charts. Let me just go to a full screen view. You would have had the levels on your charts, and you want to actually find a trade, right? So what I would do is I would try and identify levels on the charts that I can use to actually help me find entry points, and to help me identify proper entries and exits. The first thing that I would do, I've got the weeklies and monthlies, and I would then look for the dailies, meaning I would go to the daily time frame to actually identify daily levels that we have. First of all, we have this level from the left hand side. Once again, I'm using the close and the open of these two bodies, dragging it across the charts to actually identify the closest level that we have. And I can see that right at the top of this wick, we have got some kind of sensitivity that is happening, which would have helped me with my entries for the day. And again, I do see that this support level has been a level that has been kind of a problem. I'm going to mark out this level as well to actually know what I can do then moving forward. All right. So this is what I have. So I've got that general level at 107.159, and I've got these two zones that the market is stuck in. Then I'm going to zoom into the smaller time frame, the H4 to be specific. When I get to the H4, I can maybe try and modify these levels to something that makes a bit more sense than what we have on the charts right now. So I can maybe take up that rectangle tool to the close and the open of these two candles. So I can see that the market has been struggling around this level. So the market has been ranging around these levels, and there's a high chance that we can actually see a drop on this level. And if not a push to the upside, we can get a break out of this level and a retest of this level, and from there we can see this immediate support from the daily. Right, so from there I'm gonna then zoom into a smaller time frame to help me understand entries. So smaller time frames, what am I looking for? There is both these open and close of these two wicks. I'm gonna mark those out as well, so mark them out. Remember guys, we wanna identify levels of entries, and we want to see what it is that we can use to actually get entries. Right, so when I zoom in, I can see, so this is the H4 level, so this is the 4-hourly level. How I got that level is I drew a line, so a line from the open and close of these two bodies, and I put it at the tip of that wick, I put it at the tip of that wick, which is almost the same. So this line touches all wicks and also touches the open and the close of the body. Refer to previous videos to actually understand how we can draw these levels. Then I can go to the H4, H1, and the only thing that I would wait for is to get a dip into that level. Then I can then get entries. So how you can basically get entries is through the break out of these smaller time frame levels. Look at this level over here. I'm going to be doing this, guys. It's there literally throughout the markets, right? So this line, so the open and the close of all those 4 wicks and the median level. So you can see that it touches 1, 2, 3 wicks at the bottom. Then you can see how we came to spike through this level. If you zoom into 30 minutes, you would have seen how you would have gotten a clean entry around these levels. So this would have been an anticipated level of entry for me. And this would have been the first target. Obviously, a break past this target would have led us to that level over there, because then that's the next immediate support we have. So right now, how you would have gotten entries is you would have honestly gotten entries around this level, right? So there's specific things that we look for around these levels. Number one being multiple wicks to that level. So if the market is wicking, look at that. We've got 1, 2, 3, 4, 5, 6, 7, 8 wicks on that level, meaning that's a level that has been holding strongly. I mean, if you've got 8 wicks wicking to that level, then that's actually a strong level. Look at this, right? If you go to the hourly time frame, you will see how much we wicked to that level. So we've got 1, 2, 3 wicks to the high before we actually started seeing this roll over. So you look at the wicks to the high for you to get entries. So the multiple wick formation consists of the number of wicks that you have. Look at this, even on support areas, look at that. You have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 wicks to the high, and the market pushes to the upside. So the market tends to give you multiple wicks to a specific area whenever it is going to move out of that level. So you need to pay attention and note how the market actually forms around those levels. So from here, you can play around different time frames to understand this. So looking at this, right, looking at this on the 4 hourly, we actually broke out of this level. So how you can actually identify breakouts, you can see full candle closure below that level to identify a breakout, and then that retest is what we are actually trading. We're not trading this candle. We're going to wait for the market to come back, retest that level, then we can actually sell from that level to the next immediate support. So if you look at this, this is beautiful. There's a lot of confirmations on this chart. So the market broke past this level. Number two, the moving averages are about to cross. I'm pretty sure that when we go to the H1, they have actually crossed. Look at that. They crossed over there, confirming the beginning of a new trend, which would have given us an entry as well. And number two, now the moving averages are crossing on the H4 to even confirm the lock of that drop. And if you look at the general bias of what is happening on the H4, we do have a ranging market. So the market pushes up and down, up and down, up. And from here, we do expect that the market can come back here. So this can be a level that we can anticipate on the chart. So you would have gotten an entry using these levels, these breakouts. You would have gotten entries. And again, if you go to the smaller time frame, right? So this is another thing that you can actually observe and monitor as you are trading, right? So you do have this level. So I refrain from using smaller time frames because smaller time frames don't really give us what is really happening. So we have a lot of noise on the smaller time frames, and we can actually abandon good trades simply because of what is happening on a smaller time frame. And again, you can even stay on failing trades if you don't really look at smaller time frames and even ignore what is happening on smaller time frames. So if you go to the M15, let's see what is happening on the M15. You can actually see that we actually broke out of this level, and the M15 is currently retesting this level. I do expect that this M15 should leave a spike. So if we get a spike on this level, so if the market closes below this level, then I can actually come in and take this trade to the next available support, which in this case would be that level. So a close below this line would be an entry for me, to be quite honest with you. That would have been an entry point for me to actually enter this trade and short it to that 107 level, 107,460. That's a good 20 pips. That's an intraday move on UJ. Remember that UJ is actually a very slow moving pair. So I would then enter this trade to the next available support. So I'm going to be doing this across different pairs, different things that we can actually look at. Remove drawing tools. Let me see. What do we have on this chart? Let me see. Okay, nearly deleted important stuff. Nearly deleted important stuff. So again, how I would have traded this market, look at what is currently happening right now. You can see that, okay, the market is actually setting up for a bullish run. How do I see that? I see that by looking at this low. Sorry, looking at this low, you do see that we've got this low and we've got that high, which in this case, that high then became a ranging market. So this whole high then became a ranging market, and that higher low also um, held. We did have a low, a higher high, and a higher low. If you look at this, you must look at it in this perspective. You do have a low, a higher, a high, and this is a higher low, and the market is currently giving us a higher high. So if you come back, give us a higher low, then we can actually see a high high. So the market is setting up nice for a bullish run on this case. But what I would have done, honestly, the first thing that I would do on this market, I would identify relevant levels. So from the closing the open of these two bodies from there, and then try and at least adjust them and modify them according to what I can logically see. So I can use this highest level because this is where the market tends to like, not break the most. So that's like the highest, strongest resistance we have on this market. So you can see that we have a bounce, and we have that third bounce over there that we just broke out of this level. We didn't really come to touch it, so we haven't really come to tap it. I wouldn't have taken this trade, to be quite honest with you, because we wouldn't have come to touch this. So the only safest trade for me would be seeing this market dipping into that zone. So if you see a dip into that zone, leave multiple wicks, this kind of formation before we go up, then I would then set up my entries for longs, looking at this immediate level for an anticipated target. Again, you can include the use of Fibonacci and everything else that we did to actually kind of understand where the next possible move can be. All right, so you can actually use that. Again, on these levels of Fib, if we're looking at entries, we're going to look at that multiple wick formation as well. Look at how the market is now wicking to the bottom. Look at that. You've got 1, 2, 3, 4, 5, 6, 7, 8 wicks to the bottom, and then the market just rises, close above moving averages, crosses over, comes back to retest this broken level of resistance from here. Hope you guys are following. From here, you do see that we've got that level of resistance, 1, 2, 3, 4, 5 spikes, and the market breaks out, comes back to retest that spiked level from the left hand side. From there, we have that moving average cross over that level, retest that. From here, we just had a rise exactly to -27. So -27 just got hit like now. You just got hit now. If you really like extend this to the right, this is when the -27 actually got hit. But this would have been a clean trade, honestly. First immediate target would have been that resistance level. If we break past that resistance level, then we obviously look at that -27. So I hope you guys are really getting these things. So I covered the multiple wick formation. I covered the fib and the difference between a breakout and a rejection. The difference between the breakout and the rejection would obviously be the close of the candle above a level. So like, let's go to this area over here. So the market gave us a rejection from the wicks. So it gives us multiple wicks at a level for us to know that it's rejecting, and it gives us full candle closures for us to know that it actually broke past that level. These are the things that we'll look at before we can actually take a trade. Even here, like, you can see how we actually got like wicks waking at the bottom, meaning that this level was actually holding. That whole area was an area of wicks actually, and then from there you did see a bullish run. But here we did get a clean bearish closure from that level, then this was actually a clear indication that we're actually like trending down. So again, how would you know that the market is faking out? Obviously, we don't just take trades based on the close above the level. We wait for the market to retest, give us a clean rejection on that support level. But if we get a close below that level, then we know that that was a fake out. So we wouldn't have traded that level, that trade, honestly, because that would have been a fake out of that level. Then the market came back below, retested that level, then it started dropping to the downside. So we don't just trade. The next formation that I want to talk about is an inside bar formation. So an inside bar formation is made out of these wicks, these candles, sorry. So you would obviously draw a line from the top of that candle to the low of that candle. So you can actually like drag this to the right. Look at that. So the market did give you that inside bar formation from the H4, and I think if you zoom into the H1, then you will see like a beautiful trade setup that would have come out of this kind of a formation. So you draw that from the H4. If you spot on the H4, look at that close above, and then the market came to retest that level. This would have been a clean entry for a buy. So inside bar formation is when the market is ranging within one candlestick. So if you look at that, we did get like a range from just this one candle. So the market did trade within this candlestick, and then we actually got a break from this one, and the market started rallying to the upside. So you can check these. They happen at support and resistance levels. So mostly these setups would be high probability setups, because then a break out of an inside bar formation means that the market will actually move towards that anticipated directional bias, all right, towards that anticipated directional bias. So do check these out, Google them, try and see more patterns, more formations of these inside bar formations. And then obviously candlestick patterns, you want to look at spinning tops, you want to look at hanging mans, you want to look at dojis. And if you look at this, you do have a doji over there. So this candle would be a doji, this would be a spinning top, this would be a shooting star, this would have been a hammer. So look at those candlesticks. So a shooting star, spinning top, doji, hammer, those are my main candles that I look at. So do look out for those and make sure that you familiarize yourselves with those. So these happen at support and resistance. You only take trades based on these formations by support or resistance. You don't just take them anywhere. These are basically very much accurate. I'm going to show you how these would have formed also on this chart. So look at that. You did have literally a hammer pattern right at support. You did have a spinning top at that level. You do have a hammer again, and then the market just pushes up. So these formations do happen either at support or resistance levels. Look at that. You do have a doji pattern at resistance that the market just started crumbling to the downside. And from here as well, you do have this previous level that got broken. So I'm going to draw that level so you can see what I'm trying to talk about. So you do have that level that got broken over there. Look at that, market gave you that indecision candlestick, which does look like a doji, then came and spiked that level, then it actually went down. So look at how the multiple spike formations happen at support. Look at how these candlestick patterns happen at support. So you look at those patterns for you to actually understand what is happening. And then again, counter trend line breakouts, you can actually use those for entries. I'm going to be demonstrating how you can use those for entries. So the market is pushing up, and then all of a sudden gives you a counter trend line move, and then a counter trend move, sorry, then you can actually start drawing a line there, and then once you see a breakout, then you take a trade going up, right? So again, you can actually like try and adjust your trend lines, take this wick over there and maybe put it on that wick over there. You can see that's still a valid breakout. Moving averages cross over, and the market just went to the upside. So you look at those kind of things to actually understand. So now this brings me to my last point of this video, the risk to reward ratio that you would use, right? So whenever you take a trade, right, so suppose you're actually trading this move, so the higher the time frame, the larger the risk. So I do prefer using smaller time frames to actually minimize my risk appetite, for me to actually know that okay, my risk will be very smaller than whatever risk I would have used on a high time frame. Suppose I come into the chart and the market is already moving, it has already moved from that level, I can clearly see that all of this, like whatever is happening around here, like there's just a level of support, whatever. There's a level of sensitivity that's happening. So if I wanted to catch this trade, I would obviously wait for the market to break past this level. So this would have been my trade. So I would have tried and actually shorted this trade literally at the retest of that level, at the retest, and targeting the next possible support level, which in this case would have been using previous market would have been this level over here. So this would have been the level of anticipation based on the previous market. Obviously, I would have had this whole thing happening from the left, and this would have been my target, honestly. And then my stop loss would be slightly above this level, because I do understand that a break above this level would mean that my trading idea would have been violated. So my stop loss would have been slightly above the previous high, because if we break past the previous high, then obviously we have violated the trading idea. So I make room for stop losses and everything. So I would obviously literally risk 339 pips for how much? For 1,678 pips. So this would have been a beautiful trade. If you look at it, 300 pips to 1,600 pips, that's a beautiful risk to reward ratio. So I'm literally risking 3.39 and my target is 16.78. So my risk to reward would have been 3 to 16. So I'm risking 3 pips for 16 pips, which is quite beautiful. So I would have risked that amount to get that amount. So this would have been a beautiful risk to reward ratio, especially if I take trades on a smaller time frame. So smaller time frames give us like a slightly better risk to reward ratio. So this, guys, is how I would have honestly dealt with my entries and my risk management and stuff. So I hope this really helps. Once again, you can rewind the videos to find out more information, to actually understand what is that I'm trying to get across on this video. And again, I will see you on the next video.